Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the effective interest rate on discounted loan. So we'll discuss what a discounted loan is, and then we'll use the effective interest rate, which will help us to kind of standardize the discounted loan so we can compare it and contrast it to normal loans to see what the best result would be. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 816 Effective Interest Rate on Discounted Loan tab in the Practice Problems section. Going to be closing this back up. We're going to have our information up top. We'll use that to work through our practice problem on down below. We're going to be using the effective interest rate method to kind of standardize what we would think of as a discounted loan, which is a weird loan, right? The discounted loan is going to be a loan that's formatted strangely. So let's think about the strangeness of the discounted loan first, and then we'll think about, okay, well, how could I compare that type of loan to some other type of loan that is normal? Well, we can kind of normalize things with the use of the effective interest rate type of calculation. So let's say we had a loan that we had we're thinking about a loan for $8,000. We're going to say that the loan is exactly for a year, so we can use the yearly percentage rate up here. So remember, our calculation is going to be our normal kind of formula to calculate interest. Is interest equals P, which is the principal or the loan amount. Typically, R is going to be the rate, which is typically the yearly rate. So anytime we see the rate, we see a yearly rate. And then we have to multiply that times the time if we have something other than a year, because then we'd have, if it's less than a year, a fraction of a year, which would be a ratio in that case on the time side of things. So in this case, time is just 1, so that'll be making it a little bit easier. So if we were to take a normal loan for $8,000, you would think we would say, all right, well, there's 8,000 times 0.15 for 1 year times time, which is just 1, right? Which is going to be $1,200 would be the interest then on that loan. That's going to be the amount of the interest under normal conditions. So under normal conditions, if we borrowed it for an entire year, and we're going to say, hey, we want to use the $8,000 for the entire year, we'll pay you back the $8,000 at the end of the year, plus we'll pay you back the rent on the purchasing power of the loan, which we call interest, the cost of the loan, which is going to be another $1,200, another $1,200. So we'd have to pay back the $8,000 plus the $1,200, pay back the original principal plus the interest of the $1,200 a year later after the term of the loan, after it's been ended. So we'd have to pay back $9,200 total. Now, if we have a discounted loan, they basically say, hey, look, we're gonna charge you. This is like the rate. They'll say this is, the interest rate, but it's not really the effective rate, because they're gonna say, hey, look, we still have that $1,200 of interest, but we're gonna take it out basically of the loan up front, and therefore you're gonna pay then the $8,000 minus 1,200 is how much we're going to pay you. So at day one of the loan, you're not going to get $8,000. You're only going to get the $6,800. So now we only got $6,800 instead of the full $8,000 that we get to use throughout the yearly time period. And then we pay back basically interest in quotes, right? The interest, the cost of the loan, which is going to be that 1,200, which they basically took out at the beginning of the loan. Now, if you think about that, they're using, like we're saying, the discount, the interest rate on the discounted loan was 15%, but that's like a different kind of rate than you would think of if the loan was having normal terms, because really you didn't get the whole $8,000 that you would get to use for the entire year. You only got $6,800 that you get to use for the entire year, and then when you pay it back at the end of the year, you're not paying back the $8,000 plus the $1,200. On top of that, you're only paying back the $8,000 at the end of the year. So it's a different setup. So you can say, well, how would I compare that, to like a normal kind of setup, what I would think of as normal interest rates, because that's what my, the normal mindset is in terms of what a normal interest rate would mean. So we're going to have to use the effective interest method. We'll use the effective interest method to do that. So remember that the method we can do this is our calculation. So you can memorize I equals P times R times T for normally the interest calculation here. And then we can rework this algebraically to be R, because we're solving for R, which is going to be basically our formula for the effective interest, the effective rate. The effective interest rate. So R is going to be equal to I, which is the interest amount for basically a year, divided by P, which is going to be the loan amount, times T, which is a fraction of the year, which in this case happens to be 1 because we have it for 1 year exactly. Now, this fraction of the year, you could pull it out of the denominator and think of it as basically inversing it and write it this way: interest divided by principal minus the interest, and this is the new component. I'll talk about that more in a second, times the days in a year, 360, 12 times 30, over the days in the loan, which is the inverse of the fraction of the loan, which be the days of the loan. So the new thing here, the thing that's a little bit different than is that this P term, we have to realize that it's not really the loan amount that they would call the loan amount. It's not really 8,000 because that's not how much you're getting. When we have the principal of the amount we actually get, it's going to be the 8,000 minus the 1,200 or the 6,800. So we have to replace basically P with that when we basically do our calculation. Just remembering that, you can write that out in the formula for the effective rate for a discounted loan, which is the same thing as the normal calculation, except for this principal is the principal minus the interest, because that's really what the principal or loan that we are getting is. So now we're going to do that. So we're going to say, all right, well, the interest, we'll do this in a couple different ways. We'll do it with this calculation, and then we'll do it with this calculation down below. So I'm going to break this calculation into basically a table format, just doing the algebra table-wise. We're going to do the first half and then the second half, and then you could standardize this in a table. Highly recommend doing it in Excel so you can just practice your Excel skills. These are great tools to practice Excel. So we got the interest, 1,200, and then we got the key thing, which is the principal minus the interest. The loan amount, or we're not going to say it's 8,000 here. We only got, under normal terms, the 8,000 minus the 1,200, so we really got at the beginning of the loan 6,800. So if we then divide that out, we're going to say, all right, then the 1,200 divided by the 6.8, that's going to give us about the 0.176, so on. And that's going to be the first half of our calculation here. Now we'll do the second half, which is going to be straightforward for this calculation. We'll do another problem. It won't be exactly a year in the next problem. That'll be the days in a year, which are 360. Not what you could use 365, but we're using even days, 30-day months times 12, 360. The days of the loan outstanding, also 360, because we have it out for 1 year. So we're going to divide those out, which of course will simply equal 1. So we're going to take then this half times this half, or the 0.176 so on times 1, which is going to give us then the 17.65%. Now, if we were to plug that back into our calculation, which is just this number here, if we plug that back into our calculation for interest, which is principal times rate times time, we could say, okay, here's the rate times the principal or the loan amount, which once again, we're not saying is 8,000, but 6,800. That's the amount of money we actually got at the beginning. We're going to say 6,800, and then we're going to say times the time, which is just 1, because it's 360 over 360, so times 1 would be that 1,200, which is the amount of interest. So we're kind of standardizing this calculation. This is what it cost us. 1,200. If we use the standardized rate, the effective rate for the discounted loan, that would be 17.65 instead of 15, right? Because of the way the loan is going to be formatted. So if I was to compare this with a related loan, it would be under normal standards. Then we would be easier to use or be better to compare the 17.65% as opposed to the 15%, so we can kind of standardize our thought process. Now we can do the same thing here and now use this calculation. So I'm going to do the same thing, but now use this calculation. So that's going to be, I'm going to have the interest up top, which is going to be that 1,200, because that's going to be the cost of the loan. So that's the cost of our loan. And then we're going to pick up the P times T. So P is going to be the new thing because it's not 8,000, it's 8,000 minus the 1,200, because that's what the loan is, 6,800. Then we'll pick up the percent of a year, which is easy here. We'll see another problem where it'll be a little bit more complex. That'll be the 360 over the 360, the days of the loan divided by the days in a year, and that'll be 1. So now we got P times T, which will be 6,800 times 1, which is going to be 6,800, and then we can take I divided by P over T, which is 1,200 divided by 6.8, which is going to be, once again, that 17.65, same calculation here. Let's do it again, but now we have the time that won't be exactly 1 year. So we're going to say, all right, here we have another set of data. We're going to say 15,500. The days are going to be 90. So now we're going to say the loan is for less than a year. It's going to be 90 days for the loan. and then we want to figure out the effective rate. So and the interest on it is gonna be 290. So they didn't give us basically, like the rate. They just told us the interest amount. So if we have the interest amount, the cost of the loan, how much we're going to be paying on the loan, then we could figure out the effective interest method. Now, if you want to think about, well, what would that rate be, the normal kind of rate calculation, if I can use the same formula here. So we got our interest equals P times R times T. And now let's use R equals I divided by P times T. Now, if this was a discounted loan, I would then say, well, P is going to be actually the 15,500 minus the 290. If I'm assuming that this 290 is like a normal loan, then P would simply be the 15,500. So let's calculate this basically assuming like a normal loan, or figure out what the rate would be, and then we'll apply the discounted format. So I'm going to use this format of the loan calculation and figure out kind of the rate based on the interest being 290, using the 15,500 as the principal. So we'd say, okay, the interest was 290. That's going to be the interest divided by P times T, which is going to be the principal at the 15,500. This is the full loan amount because we're not doing the discounted calculation. We're just trying to calculate the normal kind of interest here. And then we got the percent of a year is going to be the 90 days. So 90 days divided by the number of days in a year, which is going to be 12 times 30 or 360. So 90 divided by 360 is 25%. So 25% of the year. So now we're going to take P times T. So P times T, 15,500 times 25% gives us the subtotal 3878. And now we can take the interest divided by that subtotal, and that'll be 290 divided by the 3875. And that's going to be about 7.48 if I move the decimal over 7.48. So they might say, so again, they might say here that it was you got a 15,500, 7.48 loan, but the actual money, which means that the interest that you would have if you calculate that out would be the 290 under normal kind of loan circumstances. But you can see if I had the interest, let's do it this way. If I had the interest and I plug it back into this formula, interest would be calculated as the loan amount, 15,500 times the rate, which we said is about times about 0.0748 times time, which is a fraction of the year, 25% of the year, times 0.25, 25%, would give us about the 290 because there's rounding. So if they say that, but then they say, well, it's discounted. Well, now that the cost of the loan, the 290, they're going to take out up front. That's what it means to be discounted. So now we're actually going to only get 15,500 minus the 290. We're going to get 15,210. And so now we want to figure out, okay, well, if I'm going to get the 15,210, what's the real rate? This isn't the effective rate because you took the money out up front. That's not normal. So how can I compare the same thing to the same thing, or apples to apples, as they say? We can do the effective rate on the discounted loan, which would be the same thing, except we're going to subtract out the principal is going to be the 15,500 minus the 290. Now I'm going to do it first with this calculation, and then we'll do it again with this calculation. Same thing. So I'm going to say the effective rate on the discounted loan, we're going to do this first half is going to be the 290, the cost of the loan, the interest, divided by the principal minus the interest, or the 15,500 minus the 290, which is the amount of money we're actually going to get. That's kind of the loan that we're actually going to get under normal loan terms. So then the 290 divided by the 15,210 is going to give us this first portion, which is 0.019066. Then we'll take the days in the year, 360, 12 times an even 30 days, we're going to assume, and then divide that by the days the loan is outstanding, 90 days, and that's going to give us 4. So now if we multiply these out, we're going to say, all right, that means that the effective rate is going to be 7.63, and you can see that that's going to be different than the 7.48. So the actual rate that we would think about that we can compare to other similar loans would be, which is the effective rate, kind of standardizing this thing, 7.63. Let's do it one more time. Now using this calculation, R equals 1 I over P times T, which is same thing as this, but we're just formatting it a little bit different algebraically. So now we'll just take the effective rate. It's going to be interest, once again, that 290. And then we're going to be dividing it by P times T. P now is once again the principal minus the interest, so the 15.5 minus the 290. And then T is a fraction of a year because it's less than a year here. The days in the year are 90. And the days of the loan are 90. The days in the year are 360, which is 25% of the year. So we're taking 25% of the year. So now P times T, we got P times T is going to be 15,210 times the percentage of the year, 25%, gives us the 3802.5. And then we can take the interest divided by P times T, which is going to be, of course, the 290 divided by the 3802.5. And that's going to give us our 7.62%, about 7.62%. Now, if we wanted to recalculate this, we're going to say, all right, well, let me plug it back into this formula. I equals P times R times T. Interest equals principal or loan times the rate, yearly rate, times the fraction of the year, time. And just see if we get back to that 290, we're going to say, all right, well, then we have the principal, which is, we're going to say 15,210, because that's what we're actually going to get. We're not going to get the 15,500. Times the rate, which is going to be 0.0763 about, times time, which is 25% of a year, 0.25, 90 divided by 360, which is about the 290, because again, there's rounding involved here. So that's a method that we can use, and the effective rate is a method we could use to kind of standardize in this funny loan situation, the discounted loan. We can use it in other funny situations where we had, say, another fee on top of simply interest, like just a fee that they put on top of it. In that case, we would adjust the interest amount, the cost of the loan, to try to standardize and find what the effective interest rate would be. We'll take a look at some examples like that in future presentations.